I've spent over 40 years building Bridgewater Associates into the world's largest hedge fund, managing over $160 billion at our peak. I've studied every asset class, analyzed economic cycles across dozens of countries going back centuries, and developed systematic frameworks for understanding how money flows through the global economy. And people are often surprised when they learn that despite having the resources to invest in anything, despite having access to the best real estate deals in the world, I allocate far more capital to stocks than to real estate. Today, I'm going to explain exactly why, using the same analytical framework that has guided Bridgewater's investment decisions for decades. Now, before we dive in, let me be very clear about something. This isn't about real estate being bad or stocks being good in some absolute sense. That kind of binary thinking is intellectually lazy and leads to poor decisions. What I'm going to share with you is a rigorous analysis of the risk-adjusted returns, the liquidity characteristics, the diversification properties, and the practical realities of both asset classes. And when you run the numbers properly, when you think about these investments the way a professional allocator thinks about them, stocks come out ahead for most investors in most circumstances. You see, at Bridgewater, we don't make investment decisions based on gut feelings or popular wisdom. We build detailed models. We study historical data. We stress test our assumptions. We think probabilistically about every investment decision. And when we apply this disciplined approach to comparing stocks and real estate, the advantages of stocks become very clear. Let me start by explaining what I call the return decomposition framework, because understanding where returns come from is essential to understanding why stocks are superior to real estate for most investors. Every investment return can be decomposed into several components. There's the income yield, the cash that the asset generates. There's the growth rate, how much that income grows over time. There's the valuation change, whether the multiple that investors are willing to pay for that income stream expands or contracts. And there's the financing component, the cost or benefit of any leverage you're using. Let's start with income yield. Real estate investors love to talk about rental yields. The annual rent is a percentage of the property value. In most major markets today, rental yields are somewhere between 3 and 6% before expenses. After you account for property taxes, insurance, maintenance, property management fees, and vacancies, your net yield is probably somewhere between 2 and 4%. Compare that to stocks. The dividend yield on the S&P 500 index is currently around 1.5%, which looks lower than real estate at first glance. But here's what that comparison misses. Companies don't pay out all their earnings as dividends. They retain a significant portion to reinvest in growth. The earnings yield, which is the inverse of the price-to-earnings ratio, is currently around 4 to 5% for the broad market and significantly higher for value stocks. But the crucial difference is what happens to that retained capital. When a company retains earnings and reinvests them at high rates of return, that creates value for shareholders, even if it doesn't show up as current income. When you own real estate and retain cash to reinvest, you're limited to either improving the property you own or buying additional properties, both of which require significant additional capital and effort. Now let's talk about growth. Real estate investors expect rental income to grow over time, roughly in line with inflation or slightly faster in growing markets. Let's say 3 to 4% annually in nominal terms. That's reasonable for a well-located property in a stable market. But here's where stocks pull ahead significantly. A well-selected portfolio of stocks in growing businesses can generate earnings growth of 7 to 10% annually or even higher. This isn't speculation. This is what the historical data shows. Companies that reinvest their earnings at high returns on invested capital can grow their earnings substantially faster than inflation for extended periods. Let me give you a concrete example using real numbers. Apple has grown its earnings per share by over 15% annually for the past decade. Amazon has grown even faster. Even mature companies like Visa or MasterCard are growing earnings in the low double digits. These growth rates are simply not available in real estate except in very specific situations that require significant expertise and active management. When you combine a 4 to 5% earnings yield with 7 to 10% earnings growth, you get expected returns in the 11 to 15% range from stocks before any valuation changes. Compare that to 3 to 4% net rental yield plus 3 to 4% rental growth, which gives you expected returns of 6 to 8% from real estate. The stocks are providing nearly double the expected return. Now let's talk about valuation changes, because this is where things get interesting and where most investors make mistakes. Both stocks and real estate can experience valuation expansions or contractions. A property might trade at a 4% cap rate 1 year and a 5% cap rate a few years later, which represents a 20% decline in value, even if the rental income hasn't changed. Similarly, a stock might trade at 15 times earnings 1 year and 20 times earnings a few years later, which represents a 33% gain, even if earnings haven't changed. The key insight is that valuation changes are mean reverting over long periods. If you buy when valuations are high, you'll likely experience valuation contraction. If you buy when valuations are low, you'll likely experience valuation expansion. This is true for both stocks and real estate. But here's the crucial difference. With stocks, you can see the valuations clearly. You can look at price-to-earnings ratios, price-to-book ratios, dividend yields, and compare them to historical averages. You can make informed decisions about whether you're buying at attractive or unattractive valuations. With real estate, valuations are much more opaque. Cap rates vary by property, by location, by property type. There's no centralized market with transparent pricing. Most real estate investors have no idea whether they're buying at the top of the market or the bottom. They just know what properties are selling for in their area, which gives them no information about whether those prices are reasonable relative to historical norms. This opacity creates a dangerous situation where real estate investors frequently buy at peak valuations without realizing it. They see rising prices and assume that's normal. They project recent trends into the future, and then they're surprised when values crash, as they did in 2008. With stocks, at least you can see what you're doing. You can calculate that the market is trading at 25 times earnings versus a historical average of 16 times, and you can adjust your expectations and position sizing accordingly. This transparency has enormous value for risk management. Now let's discuss what I consider the most important advantage of stocks over real estate, which is the difference in what I call capital efficiency. This is the concept of how much return you can generate per unit of capital, time, and effort invested. Real estate is inherently capital inefficient in multiple ways. First, every property is a separate investment that requires individual analysis, negotiation, and ongoing management. You can't easily scale. If you want to invest $1 million, you might buy one property. If you want to invest $10 million, you need to find, analyze, and purchase 10 properties. Each one requires separate due diligence, separate financing, separate management. With stocks, scaling is trivial. I can invest $1 million or $1 billion using the same analytical process. I can add positions or reduce positions in minutes. The intellectual work of analyzing businesses scales in a way that analyzing individual properties never can. Second, real estate requires constant active management or the cost of hiring management. Even if you hire a property manager, you still need to oversee them, approve major decisions, handle problem situations. This is a significant ongoing time commitment that never goes away as long as you own the property. With stocks, once you've done the analysis and made the purchase, the management team of the company does all the work. You're essentially hiring some of the most talented executives in the world to manage your capital. At Bridgewater, when we buy stock in a company, we're getting access to world-class management teams that we could never afford to hire ourselves. Third, real estate ties up capital in illiquid investments with high transaction costs. If I invest $1 million in a property, that capital is locked up. If a better opportunity comes along, I can't easily reallocate. The process of selling the property and buying something else might take months and cost 6 to 8% in transaction fees. With stocks, I have complete capital mobility. If I see a better opportunity, I can reallocate capital in seconds with transaction costs under 0.1%. This flexibility has enormous value over a lifetime of investing. The ability to continuously optimize your portfolio, moving capital from less attractive to more attractive opportunities, compounds into significant outperformance over decades. Let me quantify this with a specific example. Suppose you have two investors, each starting with $1 million. Investor A buys a rental property that generates a 7% annual return. Investor B buys stocks that also generate a 7% annual return. On the surface, they look the same, but Investor A's capital is locked in real estate. She can't easily reallocate. She has to spend time managing the property. The 7% return is her maximum unless she sells and reinvests, which costs 6 to 8% in transaction fees. Investor B can continuously optimize. When he finds stocks that look more attractive, he reallocates with minimal friction. When he identifies value opportunities during market downturns, he can deploy capital immediately. Over time, this flexibility allows him to generate 8 or 9% instead of 7% through superior capital allocation. The difference between 7% and 9% might not sound like much, but over 30 years, $1 million at 7% becomes $7.6 million. At 9%, it becomes $13.3 million. That's a 75% difference in final wealth, and it all comes from the superior capital efficiency of stocks. Now, let me address what I call the liquidity premium, which is one of the most undervalued aspects of stocks compared to real estate. Liquidity is the ability to convert an asset into cash quickly without accepting a significant discount to fair value. And liquidity has enormous economic value that most investors never properly quantify. Think about what liquidity provides. First, it gives you optionality. If an emergency arises, if you lose your job, if you have a medical crisis, you can access your capital immediately without having to fire sale your investments. With real estate, you're at the mercy of the market. You might need to sell quickly and have to accept 20 or 30% below fair value. Second, liquidity allows you to take advantage of opportunities when they arise. The best investment opportunities often appear suddenly and unexpectedly. Maybe there's a market crash that makes wonderful businesses available at bargain prices. Maybe you identify a new opportunity that requires capital. With liquid investments, you can act. With illiquid investments, you watch opportunities pass by while your capital is locked up. Third, liquidity reduces risk. If you're wrong about an investment, you can exit quickly and redeploy the capital elsewhere. With real estate, if you make a mistake, you're stuck with it for months or years while you try to find a buyer. During that time, the property might continue declining in value, or it might be generating negative cash flow that eats into your capital. At Bridgewater, we actually quantify the liquidity premium. We estimate that illiquidity reduces the value of an investment by roughly 1 to 3% per year, depending on the holding period, and market conditions. Think about what that means. Even if two investments have the same expected return, the illiquid one is worth significantly less because of the reduced flexibility and increased risk. Most real estate investors never account for this liquidity discount. They compare a 7% expected return on real estate to a 7% expected return on stocks and think they're equivalent. But once you properly adjust for liquidity, the real estate investment might only be worth a 4 to 6% expected return in risk-adjusted terms. Suddenly, stocks look much more attractive. Let me now discuss the diversification properties of stocks versus real estate, because this is another area where conventional wisdom is wrong. Many investors believe that real estate provides diversification from stocks, so a portfolio containing both is better than a portfolio of just stocks. The reality is more complicated. It's true that real estate and stocks don't always move in the same direction at the same time. The correlation between the two asset classes is positive but less than 1, which technically means that combining them provides some diversification benefit. But this diversification benefit is much smaller than most people think, and it comes at a significant cost. Here's why. Both stocks and real estate are ultimately driven by the same underlying economic factors. When the economy is growing, when employment is strong, when credit is available, both asset classes tend to do well. When the economy contracts, when unemployment rises, when credit tightens, both asset classes tend to do poorly. The correlation is high enough that the diversification benefit is modest. Moreover, real estate has its own unique risks that stocks don't have. Real estate is extremely sensitive to local economic conditions. If the local economy declines, if major employers leave the area, if demographic trends shift, your property values can decline significantly even if the national economy is doing fine. This local concentration risk is a major disadvantage of real estate. Stocks, by contrast, allow you to diversify across industries, across geographies, across different types of economic exposure. When I own a portfolio of stocks, I can own companies that benefit from different economic conditions. I can own both cyclical and defensive stocks. I can own both domestic and international businesses. I can own both growth and value companies. This creates much better diversification than owning a handful of properties in the same metropolitan area. At Bridgewater, we've done extensive analysis of optimal portfolio construction, and what we've found is that for most investors, the optimal amount of direct real estate ownership is actually quite small, maybe 5 to 15% of a portfolio. The rest should be in a diversified mix of stocks, bonds, and other liquid assets. The liquidity and capital efficiency advantages of stocks are so significant that they outweigh the modest diversification benefits of real estate. Now, let me address one of the most common arguments that real estate investors make, which is the leverage argument. Real estate investors point out that they can use leverage much more easily than stock investors. You can buy a property with 20% down and borrow 80%. If the property appreciates by 20%, you've doubled your equity, even though the property only went up 20%. This leverage amplifies returns. This is true, but it's incomplete thinking. First, leverage is a double-edged sword. It amplifies gains, but it also amplifies losses. If the property declines by 20% and you have 80% loan to value, you've been completely wiped out. Your equity goes to zero. Second, leverage adds fragility and stress to your life. When you have a large mortgage on a rental property, you have to make that payment every single month, regardless of whether you have tenants, regardless of what the property is worth, regardless of what else is happening in your life. If you lose your job or have an emergency, you might not be able to make the payment and you could lose everything. Third, and most importantly, you can use leverage with stocks too if you want to. You can buy stocks on margin, though I generally don't recommend it for most investors. But the key point is that the ability to use leverage isn't unique to real estate. If leverage is what creates the superior returns, you could theoretically get the same benefit by buying stocks with leverage. But here's the thing. At Bridgewater, we generally don't recommend that individual investors use significant leverage with any asset class. Leverage increases expected returns, but it also dramatically increases risk. For most people, the additional risk isn't worth the additional return. You're better off owning assets without leverage and sleeping well at night. The fact that real estate almost forces you to use leverage isn't an advantage. It's actually a disadvantage. It means you're taking more risk than you might want to take, and you're doing so because that's the only way to make the economics of real estate work, given the high transaction costs and low net yields. Let me now discuss what I call the tax consideration, because this is another area where real estate investors often claim an advantage. Real estate does have some legitimate tax benefits, particularly depreciation deductions that can shelter rental income from taxation. But these benefits are smaller than most people think, and they come with significant drawbacks. First, depreciation is a timing benefit, not a permanent benefit. You get to deduct depreciation from your rental income each year, which reduces your taxes. But when you sell the property, you have to recapture that depreciation and pay taxes on it. So you haven't eliminated the tax, you've just deferred it. Second, the depreciation benefit only applies to the building, not the land. In expensive markets, where land represents 50% or more of the property value, your depreciation deductions are much smaller than you might expect. Third, to get the full benefit of real estate tax advantages, you generally need to qualify as a real estate professional under IRS rules, which requires spending at least 750 hours per year actively participating in real estate activities. For most investors with full-time jobs, this isn't realistic. Meanwhile, stocks have their own significant tax advantages that real estate investors often overlook. If you hold stocks for more than 1 year, you pay long-term capital gains rates, which are lower than ordinary income rates. More importantly, you only pay taxes when you sell. If you buy stocks in great companies and hold them for decades, you get tax-free compounding for that entire period. Let me give you a concrete example. Suppose you buy $100,000 of stock in a great company. Over 30 years, it grows to $1 million. During that entire 30-year period, you pay no taxes on the gains. The full amount compounds tax-free. When you finally sell, you pay long-term capital gains tax on the $900,000 gain. Compare that to real estate. You're paying property taxes every single year based on the assessed value. These taxes come directly out of your cash flow, reducing the amount available to compound. Even with the depreciation deductions, you're paying more in ongoing taxes than you would with stocks. Moreover, stocks give you much better control over when you realize gains and pay taxes. You can strategically harvest losses in down years to offset gains. You can donate appreciated stock to charity and avoid capital gains taxes entirely while getting a deduction for the full market value. You have flexibility that real estate doesn't provide. Now, let me discuss what I call the human capital consideration, which is the relationship between your investments and your career. This is something that most investors never think about properly, but it has enormous implications for optimal portfolio construction. Most people's largest asset isn't their investment portfolio. It's their human capital, their ability to earn income from their labor over their working lifetime. And the risk characteristics of your human capital should influence how you invest your financial capital. Here's the key insight. Real estate investing requires significant time and effort. Even if you hire a property manager, you still need to find properties, negotiate purchases, oversee management, handle major decisions. This is time that you're not spending on advancing your career, developing your skills, or building your earning power. For most people, especially young people early in their careers, investing in yourself, developing valuable skills, building your professional network, and advancing in your career will generate much higher returns than any investment you could make in real estate or stocks. The difference between a mediocre career and a great career might be hundreds of thousands or millions of dollars in lifetime earnings. Real estate investing takes time away from career development. Stock investing, once you've learned how to do it properly, requires very little ongoing time. You can manage a portfolio of stocks in a few hours per month. This leaves you free to focus on your career and building your human capital. At Bridgewater, we've analyzed this trade-off quantitatively. For most professionals in their 20s, 30s, and 40s, the return on investing time in career development is often 20 to 30% per year or higher. The return on spending that same time managing rental properties is maybe an additional 2 to 3% on the real estate returns. It's not even close. You should be investing in your career, not spending weekends dealing with tenant issues. Let me now address the behavioral and psychological aspects of investing in stocks versus real estate, because this is perhaps the most subtle but most important difference between the two asset classes. Real estate investing feels safe to most people. You can see the property, you can touch it, you can drive by and look at it. This tangibility creates a psychological comfort that's very powerful. When you own stocks, you just see numbers on a screen. It feels abstract and less real. But this psychological comfort is actually dangerous because it creates an illusion of safety and an illusion of control. Real estate isn't actually safer than stocks. During the 2008 financial crisis, real estate declined by 40 to 50% in many markets. That's worse than the stock market decline. But because you don't see daily price quotes on your rental property, the volatility feels less severe. This is what behavioral economists call money illusion or the transparency effect. When you don't see the volatility, it feels like it's not there. But the volatility is still there. The risk is still there. You just don't see it. Moreover, the illusion of control that real estate provides is actually counterproductive. Real estate investors think they're in control because they're actively managing the property, but they're not actually controlling the things that matter. They're not controlling local economic conditions, demographic trends, interest rates, property tax policy, or the myriad other factors that determine real estate returns. With stocks, you give up the illusion of control and accept that you're a passive owner in a business run by professional management. This feels uncomfortable at first, but it's actually liberating. You're not wasting time and energy trying to control things you can't control. You're accepting the reality of the situation and focusing on what you can control, which is picking the right businesses and holding them for the long term. At Bridgewater, we've studied the behavioral mistakes that investors make, and we found that real estate investors actually make more behavioral errors than stock investors, despite feeling more confident. Real estate investors hold losing investments too long because selling is so difficult. They fail to properly account for all their costs. They overestimate their returns because they're not tracking them properly. They take on too much leverage because the mortgage doesn't feel like risk the way margin debt feels like risk. Stock investors, especially those who use a disciplined approach, actually make fewer behavioral errors because the feedback is clearer. You can see exactly what you own, what it costs, what it's worth now, and what your returns are. This transparency, while sometimes uncomfortable, actually leads to better decision-making over time. Let me now share my specific framework for how to invest in stocks successfully, because understanding why stocks are superior to real estate is only half the battle. You also need to know how to actually implement a stock-based investment strategy. At Bridgewater, Our investment process is built on what I call radical transparency and systematic decision-making. We don't rely on gut feelings or market timing. We build models based on fundamental economic relationships, and we stress test those models against historical data across different economic environments. For individual investors, you don't need Bridgewater's sophistication, but you do need a systematic approach. Here's what I recommend. First, diversify broadly across geographies and asset classes within stocks. Don't just own U.S. stocks, own international stocks, including both developed and emerging markets. Own both large cap and small cap stocks. Own both growth and value stocks. This diversification protects you from the risk that any single market or style underperforms for an extended period. Second, rebalance systematically. This means when one part of your portfolio does well and becomes overweighted, you sell some and buy the parts that have done poorly and become underweighted. This forces you to buy low and sell high, which is exactly what you want to do, but is psychologically difficult. Third, focus on total return, not just current income. Many investors make the mistake of chasing yield, buying stocks or real estate that generates high current income. But total return is what matters. A stock that pays a 2% dividend but grows at 12% gives you a 14% total return. That's better than real estate that yields 6% but only grows at 3%. Fourth, minimize costs and taxes. Every percentage point you pay in fees or taxes is a percentage point that's not compounding. Use low-cost index funds for core holdings. Be tax efficient in your trading. Hold stocks long-term to minimize capital gains taxes. Fifth, and most importantly, match your portfolio to your tolerance for volatility. Stocks are more volatile than real estate in the short term, at least as measured by quoted prices. If you're going to panic and sell during a downturn, stocks might not be right for you. But if you can maintain discipline and hold through volatility, stocks will generate superior long-term returns. Let me give you a concrete example of how this plays out. During the 2008 financial crisis, the S&P 500 declined by about 50% from peak to trough. That was terrifying for investors who were watching their portfolio values decline by half. Many investors panicked and sold at the bottom, locking in permanent losses, but investors who maintained discipline and held through the downturn saw their portfolios fully recover within 5 years. By 2013, the S&P 500 had exceeded its pre-crisis high. By 2020, it had more than tripled from the crisis low. Investors who held through the volatility did extremely well. Real estate experienced similar or even worse declines during the 2008 crisis. But the declines felt less severe because there were no daily price quotes. This allowed real estate investors to hold through the downturn more easily. But this is a psychological benefit, not an economic one. The risk was the same, it just felt different. If you can train yourself to think like a professional investor, to ignore short-term volatility and focus on long-term fundamentals, you don't need the psychological crutch of illiquidity that real estate provides. You can capture the superior returns of stocks while maintaining the flexibility and liquidity to take advantage of opportunities. Now, let me address one final consideration, which is the role of real estate in a complete financial plan. I'm not saying that you should never own real estate. I'm saying that direct ownership of rental properties is usually not optimal for most investors when compared to stocks. But there are other ways to get real estate exposure that avoid most of the disadvantages I've outlined. You can own real estate investment trusts, or REITs, which are publicly traded companies that own and operate real estate. REITs give you real estate exposure with stock-like liquidity, no management responsibilities, better diversification, and lower transaction costs. You could also own your primary residence, which provides utility value beyond just investment returns. You get to live in the home, and there are tax benefits to home ownership that don't apply to rental properties. But even here, I'd caution against overinvesting in your home. Many people buy more house than they need and tie up too much capital in a single illiquid asset. My general recommendation is that for most investors, total real estate exposure, including your home and any REITs, should be somewhere between 20 and 40% of your total net worth. The rest should be in stocks, bonds, and other liquid assets. This provides some real estate exposure for diversification while maintaining the capital efficiency and flexibility that liquid assets provide. I've been managing money for over 40 years now. I've lived through multiple market cycles. I've studied economic history going back centuries. And I can tell you with complete confidence that for most investors, a diversified portfolio of stocks will generate superior risk-adjusted returns compared to direct ownership of rental real estate. The higher expected returns, the superior capital efficiency, the better liquidity, the easier diversification, the lower time commitment, and the better tax treatment all compound over decades into an enormous advantage. Real estate has its place in a balanced portfolio, but it should be a supporting role, not the leading role. At Bridgewater, this is how we think about asset allocation for our clients. We use sophisticated optimization models that consider expected returns, volatilities, correlations, and liquidity constraints. And consistently, those models suggest that the optimal portfolio for most investors is heavily weighted towards stocks, with real estate playing a smaller supporting role. The data is clear. The analysis is rigorous. The conclusion is inescapable. For building wealth over a lifetime, stocks are superior to real estate for the vast majority of investors. Focus on stocks, maintain discipline through volatility, and let compounding work its magic over decades. That's the path to financial success.